Here's the brutal truth most traders never admit. 96% of people lose money trading stocks. Not because the market is unfair, but because they misunderstand risk, position size, and the psychology of waiting. Amateur traders chase price, fear missing out, and double down when fear and greed collide. Professionals? They see a different game entirely. Nicholas Darvas once said, "I let the tape tell me when to act." Few understood what he meant. Most traders watch charts like spectators at a football game, hoping luck will land in their lap. Darvas, however, used pivotal points to create an invisible guide, rules that let him move confidently through volatility. Imagine this scenario: the market is moving fast, headlines are flashing, and everyone around you is celebrating big wins. Your heart pounds, your palms sweat. The amateur in the room sees opportunity and leaps, risking 10% or more of their account on a single trade, driven by the fear of missing out. The professional, by contrast, steps back. They measure risk, calculate position size, and look for confirmation at a pivotal point before making a move. This difference is more than method, it is mindset. The amateur trades emotions, the professional trades structure. The stock soars past the initial breakout. Amateurs cheer, then panic as it dips slightly. Professionals, however, watch patiently. They understand that the tape speaks in volumes and patterns, not in hope or hype. They know that the market often teases before it proves, and only by letting the tape tell its story can true opportunity be recognized. Every candle, every tick on the tape is a sentence in the market's ongoing narrative, and reading it properly separates winners from the 96% who fail. Many traders believe that buying fast and selling faster is skill. Darvas taught otherwise. Waiting, he argued, is as much a position as holding stock. Amateurs ignore this principle. They see waiting as idle or passive. Professionals recognize that the discipline to wait for the right pivotal point, to let confirmation arrive, is often the most profitable trade of all. Think about the trades you've lost in the past. How many could have been avoided if you had simply paused, measured, and let the tape confirm? The ability to delay action in the face of excitement is the cornerstone of professional trading. It is the difference between reacting and responding, between gambling and investing with control. Darvas also knew that fear and greed are powerful forces that distort judgment. The amateur's fear of missing out pushes them to overtrade. Their greed tempts them to hold onto losers or over-leverage winners. Professionals, however, use these emotions as signals rather than directives. Fear tells them to tighten stops. Greed reminds them to confirm the market's proof before adding exposure. They control their position size and place stops at pivotal points, ensuring risk is defined and limited. Another secret lies in understanding that price alone does not dictate a trade. It is the context of the tape, volume, and pivotal points that reveals opportunity. Amateurs see charts and patterns as fortune-telling tools. Professionals see them as guides to measure risk and define entries. Here's the truth that will carry through this series. The market rewards patience, structure, and controlled risk, not impulsive excitement. By the end, you will see why waiting, measuring, and sizing small isn't boring. It is the very essence of consistent profits. The Darvas rules only 2% follow are not about fancy indicators or secret signals. They are about mastering psychology, respecting pivotal points, and letting the market reveal itself to you. They are about trading like a professional in a room full of amateurs. And the first critical insight, the one most ignore, is this: waiting is as much a position as holding stock. Most traders never live this rule. Professionals breathe it. In the next chapter, we will explore the first actionable Darvas principle: cutting losses fast. Amateurs fear it, professionals live it, and once you embrace it, you begin to see why patience, above all else, is profit. Amateurs hate stopping out. They nurse losing trades, hoping the market will turn around. Fear and greed twist their judgment, and losses compound like interest, silently eroding both capital and confidence. Darvas faced this fear repeatedly. He once bought a stock breaking out of a box pattern, only to see it fail within days. Instead of panicking or doubling down, he exited immediately, taking a small, controlled loss. The market did not punish him. His own inaction and indecision would have done far more damage. This anecdote matters because it crystallizes a universal principle: risk is money you haven't yet earned, and your first job is to protect it. Professionals treat each trade like a laboratory experiment, observing results, testing hypotheses, and controlling variables. The stop loss is not a suggestion, it is a sacred rule. No exceptions. Here's how the professional operates. Before entering a trade, identify the pivotal point that will define success or failure. Place your stop just below it. Size your position small, never risking more than 2% of your account on a single trade. Let the tape do the talking. Watch for confirmation. If the market fails to validate your thesis, exit without hesitation. Doing nothing is sometimes the best trade. It may seem passive, but it is decisive action in disguise. Survival precedes all profits. Maxim, the first rule of profit is survival. It is not glamorous, but it is the foundation of every long-term winner. Every amateur who ignores this rule discovers the cost the hard way, emotionally and financially, through stress, sleepless nights, and eventually depleted capital. Look at the behavior of amateurs. They obsess over profits, hoping for gains that justify their mistakes. They count candles, calculate potential, and justify holding losers. Professionals, however, invert this mindset. They think first about loss control, then about opportunity. This is a chasm that separates the 96% who fail from the 2% who survive and thrive. The ability to cut losses fast requires discipline, not insight. It requires trusting rules over emotions, structure over impulses, and the tape over intuition. Darvas' genius was in creating a system where these rules were non-negotiable, removing emotion from decision-making. Here's an example of protocol in practice. Suppose a stock breaks out of a box but stalls the following day. The amateur clings to hope, fearing regret more than acknowledging reality. The professional checks volume, tape behavior, and pivotal points. If confirmation fails, they exit immediately. The loss is small, capital is preserved for the next opportunity. Over time, this repeated habit compounds, not in gains alone, but in freedom from fear, clarity of judgment, and confidence in execution. Notice the deeper lesson. Cutting losses fast is not just about exiting a bad trade, it is preparing the mind to act correctly when a true opportunity appears. Only once the discipline of loss control is embedded can the professional safely pyramid positions, add exposure, and scale without greed overriding logic. Every tranche added is validated, every risk calculated, because the first principle, survival, has already been honored. Amateur traders invert this sequence, risking large, hoping for luck, and often paying dearly. Remember, the stop loss is not punishment, it is insurance. Risk is always defined, profit is optional. Professionals internalize this principle until it becomes reflexive. The moment you act without emotion, guided by pivotal points and confirmed tape, you step into the mindset of the 2%, leaving the losing majority behind. And the next lesson builds directly from this foundation: pyramiding. It looks simple on paper, but in practice, it separates disciplined professionals from impulsive amateurs. You cannot pyramid effectively if you fear cutting losses, and you cannot survive in the market without that fear mastered. Most traders misunderstand pyramiding. They see a rising stock and assume buying more equals more profits. Amateur error number 2, they forget that risk scales with size. The more you add, the more you expose yourself, not just to the market, but to emotional turbulence. Darvas' pyramid, yes, but with discipline. Each new tranche was only added after the tape confirmed upward momentum, each measured against a pivotal point. Nothing was assumed, nothing was impulsive. He let proof, not hope, dictate the growth of his positions. Picture this scenario: a stock rises 12% in 3 days. The amateur sees green candles and panic buys, tripling the original position. The market hesitates, then reverses. The account swings wildly, fear sets in, and decisions become erratic. Emotional carnage ensues. Darvas? He waited. Volume confirmed strength. Pivotal points aligned. He added only small tranches, gradually compounding profits while keeping risk under control. The difference is stark: one trader rides emotion, the other rides structure. The professional protocol is simple but rigorous: add only when the market proves your thesis. Place new stops at prior pivotal points. Size each tranche smaller than the last, not larger. Never let greed dictate the pace. Each addition is a calculated experiment, a measured response to market validation. Maxim: grow your position with proof, not hope. It's short, quotable, but the wisdom is deep. It encapsulates the mindset that separates disciplined traders from amateurs who pile on risk recklessly. Here's a nested clue. Pyramiding works only if losses are cut fast first. If you haven't mastered exiting failing trades, pyramiding is a disaster. Chapter 2 isn't optional, it's foundational. Professionals think in layers: loss control, proof, patience, then size. Amateurs do the opposite: size first, hope second, panic eventually. This sequencing is the invisible skeleton of professional trading. Understanding it changes everything. A pattern interrupt is necessary here. Sometimes, the most profitable action is no action at all. Watching the tape without acting, confirming the move, and waiting for the pivotal point can outperform any impulsive trade. Patience is an active skill, not idle waiting. Most amateurs never internalize this. They see pauses as hesitation or missed opportunity. Professionals know it is profit in disguise. Let's consider a micro example. The tape signals momentum, but one candle falters at a pivotal resistance point. The amateur jumps in, fearful of missing the move. The market reverses. Loss. Darvas waits. Confirmation returns. He enters. Gains follow. The lesson is subtle but powerful. Every addition without proof is a gamble. Every addition with proof is controlled leverage. Over time, these small disciplined increments compound into substantial gains while keeping emotional stress manageable. Notice how pyramiding ties to patience. You cannot pyramid effectively if you cannot wait. You cannot wait if you cannot control fear. You cannot control fear if you have not respected stops. Every rule builds on the previous. Professionals understand these interconnections intuitively. Amateurs learn them painfully. By mastering pyramiding, you transition from reactive trading to strategic scaling, where every position and every addition has a purpose defined by the tape and pivotal points. The next critical step builds directly on this foundation: patience as a position. Amateurs violate this constantly, entering trades impulsively and exiting prematurely. Professionals treat waiting as an active stance, a trade in itself, and it is here that emotional control becomes tangible profit. By embracing patience, you unlock the next level of disciplined growth and pave the way for consistent success. Amateurs see waiting as wasted time. They feel compelled to act, fearing missed opportunity, letting impatience dictate their trades. Professionals, on the other hand, view waiting as an active strategy, a deliberate position in itself. Darvas demonstrated this repeatedly. He would stare at the tape for days, refusing to enter until the stock cleared a pivotal point and confirmed its strength. Patience was never boredom, it was precision, discipline, and ultimately profit. The tape would speak, and he listened. While others jumped in, chasing every green candle, he let the market earn him money on its terms, not his emotional impulses. Consider a simple example: a breakout forms, but the candle isn't convincing. The amateur sees excitement, jumps in immediately, and suffers the predictable loss when the market fails to follow through. Darvas, however, waits. He watches volume, price, and tape behavior. Confirmation appears, and only then does he enter. The stock skyrockets. The difference is not luck, it is method, patience, and unwavering adherence to structure. Waiting was his position until the market validated his thesis. The professional rule is straightforward: treat waiting as part of your trade plan. It is not passive, it is active. Your position is not solely the shares you hold, it is the patience you exercise until all criteria align. This mindset is the invisible force behind disciplined pyramiding, precise stop placement, and consistent risk management. Maxim: your most profitable position is often the one you never take. It is short, memorable, and uncomfortable for most traders, because it forces them to question action, impulsivity, and ego. Seed clue: the patience you exercise now ensures you can pyramid later safely. The amateur inverts this order. They trade impulsively, pyramid recklessly, then face emotional collapse when the market moves against them. The professional waits, validates, then scales, ensuring risk is controlled at every step. Without this foundation, pyramiding, tape reading, and pivotal point analysis become chaotic or downright dangerous. Waiting is the connective tissue that links all Darvas principles into a coherent framework. Another real-world scenario illustrates this. A stock consolidates near a pivotal resistance point. The amateur, worried about missing a breakout, jumps in prematurely. Price falters. Panic ensues. Darvas waits. Volume aligns, the breakout confirms, and he enters. The market moves decisively. This repeated habit of disciplined waiting allowed him to compound gains while minimizing risk. It also conditioned his psychology, reinforcing confidence and emotional control, which amateurs consistently lack. Waiting is also about controlling fear and greed. Fear tempts amateurs to enter too early, while greed tempts them to chase momentum without proof. Professionals neutralize these emotions through structured waiting, using the tape and pivotal points as their guide. Every day spent watching and confirming is not lost time, it is preparation for high-probability opportunities. Finally, patience as a position strengthens every other rule. It is a prerequisite for pyramiding, a safeguard for stop-loss adherence, and the foundation for reading the tape accurately. Professionals internalize this principle until it becomes reflexive, making decisions without the distortion of emotion. Amateurs, by contrast, ignore it and suffer predictable losses. In the next chapter, we will explore tape reading and confirmation, the hidden skill that turns observation into actionable insight, separating Darvas-level professionals from the majority who only glance at charts and call it trading. Most traders ignore the tape story. They look at candle colors, volume spikes, and indicators, mistaking noise for insight. They interpret charts through hope, bias, and wishful thinking, often ending up trapped in positions that move against them. Darvas approached the tape differently. He read it like a novel. Each trade had a narrative: price versus volume, pivotal point versus breakout, confirmation versus hype. He didn't guess, he observed, waited, and let the market tell him its story. Each tick, each block of volume was a sentence, a clue, a signal that could confirm or invalidate his thesis. Consider this scenario: a stock moves up 5% in 3 days, but volume weakens on each push. The amateur assumes strength and jumps in, confident that momentum alone guarantees a breakout. The stock falters, and losses begin to pile. Darvas, however, waits. He watches the tape, noting where buyers hesitate and where volume picks up. At a pivotal point, the market finally confirms the breakout with strength and conviction. He enters. The stock moves decisively, and profit follows. The difference is not luck, it is the disciplined interpretation of real-time evidence, unclouded by emotion or bias. The professional protocol is clear: learn to read the tape in context. Price alone is noise. It tells you little about the market's intentions. Volume, momentum, and pivotal points reveal the truth. Watch how the market behaves at these levels, and let confirmation guide your actions. Never trade against the tape. It does not argue or debate, it simply reflects the balance of risk and reward at any moment. Maxim: the tape is always right, your bias is always wrong. This simple phrase encapsulates the professional mindset. Amateurs argue with the tape, professionals follow it. Here's a pattern interrupt to internalize. You will lose consistently if you interpret the market through hope, wishful thinking, or fear of missing out. Professionals do not trade on what they want to happen, they trade on what the tape proves is happening. Observation precedes action, and patience precedes profit. Waiting for confirmation at pivotal points ensures that when you enter a trade, risk is defined, momentum is validated, and probability is in your favor. Ignoring the tape is akin to sailing blind through a storm. You may survive once or twice, but eventually, the market's currents will overwhelm you. Another example: a stock consolidates near a historical high. Indicators flash green. Candles look strong. The amateur interprets this as certainty and enters aggressively. The stock wavers. Fear sets in. Losses mount. Darvas looks at the same scenario and reads subtle cues: order flow, volume clusters, and price reactions at critical levels. When the tape aligns with his box analysis, he enters confidently. The result: a smooth, controlled position with well-defined risk and amplified potential for gain. The discipline of tape reading transforms uncertainty into actionable knowledge. Understanding tape is also a psychological tool. It tempers fear and greed by providing objective signals. Fear tempts amateurs to exit prematurely, greed tempts them to chase or overextend. Professionals neutralize these impulses by letting the tape confirm before acting. Every trade becomes a function of evidence, not emotion. Mastering the tape is mastering the market's language, and it is the bridge between patience, pyramiding, and position sizing. It ensures that every addition, every stop, and every exit is justified by proof, not hope. Next, we tackle fear and greed, the silent killers of amateurs and the playground of professionals. Understanding the tape sets the foundation, but controlling emotion allows the professional to execute flawlessly. Without this control, even the best observations can lead to catastrophic errors. Amateurs are emotional. Fear makes them exit too soon, surrendering potential gains. Greed makes them hold too long, risking profits that could have been secured. Both are silent killers, eroding capital and confidence without warning. Darvas confronted these impulses daily. He once hesitated to enter a breakout, paralyzed by fear of making a mistake, and missed the initial move. Yet when the tape later confirmed strength at the pivotal point, he re-entered with confidence. Greed, on the other hand, was controlled through strict position sizing and adherence to predefined rules. He never allowed emotion to dictate exposure. Every trade was governed by discipline, not desire. The professional rule is straightforward: acknowledge fear and greed, but never trade them. Accept their presence as natural signals, not commands. Set stops, define position size, and let the tape guide your decisions. Emotion becomes data rather than a directive. The amateur acts on impulses, jumping into trades when fear pushes or holding when greed lures. Professionals observe emotion, quantify risk, and respond only when the market confirms opportunity. Maxim: emotion is your costliest counterparty. It is short, memorable, and brutal, because every unfiltered emotional decision is a potential loss waiting to happen. Fear and greed are intertwined with every other rule in Darvas' system. Cutting losses fast becomes impossible if fear clouds judgment. Pyramiding becomes reckless if greed dominates. Waiting, tape reading, and adherence to pivotal points all depend on psychological control. A professional sees emotion as part of the trading environment, an obstacle to navigate, while amateurs surrender to it, letting it dictate timing, size, and strategy. Recognizing this distinction is critical. The same stock, the same breakout, the same tape can produce two very different outcomes depending on the trader's emotional framework. Consider a practical scenario. A stock consolidates at a pivotal point. The amateur, seeing green candles and hearing hype, fears missing out and enters prematurely. The trade falters. Panic sets in. Losses accumulate. Darvas, in the same setup, monitors the tape and volume. He acknowledges the nervousness rising inside him but uses it as a cue to wait for confirmation. When the breakout proves valid, he enters methodically, with proper position size and stops in place. The result is a controlled, high-probability trade executed without emotional interference. Controlling fear and greed also preserves mental bandwidth for critical decision-making. Professionals are able to pyramid only because they have mastered their impulses. They can scale positions logically, add tranches at confirmed levels, and remain patient even when others are panicking. Every decision builds on the psychological framework of discipline, proof, and structure. The amateur, lacking this mastery, is always reactive, always late, and always exposed to unnecessary risk. A nested clue emerges here. The psychological discipline of fear and greed management underpins every other Darvas principle. Without it, stops are ignored, waiting is impossible, pyramiding becomes reckless, and tape reading loses clarity. Professionals internalize emotional control until it is reflexive, ensuring every trade is measured, structured, and defensible. Amateurs never reach this stage. They are bound by the whims of emotion, perpetually trapped in cycles of regret and impulsivity. Next, we reveal Darvas Rule number 6, the box system and pivotal points, where structure meets discipline. Understanding and controlling emotion primes the trader to see boxes not as arbitrary lines, but as meaningful guides for action. Here, psychology and methodology converge, allowing the professional to act decisively where amateurs hesitate. Mastery of fear and greed transforms observation into opportunity. Darvas' box method is iconic because it combines structure with discipline, creating a framework that guides every decision. Amateurs often ignore structure entirely, chasing volatility, following every green candle, and reacting to headlines rather than observing the market's underlying behavior. They see movement as opportunity, when in reality, movement without context is chaos. Darvas, however, defined ranges carefully, noting pivotal points that signal genuine breakouts. A stock moves sideways? Define a box. Identify the high, the low, and mark the boundaries. Breakout occurs? Confirm volume and tape behavior before entering. Every move is justified by structure, not speculation. The professional rule is clear: Every position must respect a defined box. Place stops just outside the boundaries. Let the tape confirm the breakout. Do not enter prematurely. Do not chase. The box is more than a visual aid, it is a behavioral guideline that transforms ambiguity into a measurable decision. Maxim: trade the structure, not the noise. It is concise, memorable, and profound because it forces the trader to focus on objective signals rather than emotional impulses. Amateurs rarely follow this principle. They act on hope, assuming the market will align with their desires. Professionals act with clarity, letting structure dictate timing, size, and risk. Consider a scenario: a stock consolidates for 10 days within a narrow range. The amateur, seeing minor upward moves, buys impulsively, hoping for a breakout that may never arrive. The stock wavers, and stress mounts. Darvas, in the same situation, defines the box, identifies pivotal points, and waits. When the tape and volume confirm a true breakout beyond the box, he enters. Risk is defined by the stop just below the box, and the probability of success increases. This disciplined approach turns waiting into a strategic advantage and allows pyramiding later with minimal emotional interference. Boxes also clarify how multiple principles interconnect. Waiting is simpler when a box defines the area of potential action. Pyramiding becomes precise because each new tranche can be added at confirmed levels beyond the pivotal point. Tape reading aligns because the structure highlights areas where price and volume matter most. Professionals internalize this alignment, making trades almost formulaic, yet flexible enough to respond to real-time data. Amateurs, in contrast, try to overlay rules haphazardly, often ignoring boxes, acting on fear, and compounding errors. Another key point: the box system converts ambiguity into measurable risk. Every trade has a natural exit point, the stop just outside the box, ensuring that losses are limited and survival is prioritized. This eliminates guesswork, emotional reversals, and impulsive decision-making. Even in volatile conditions, professionals can act decisively because structure guides them, while amateurs flail, reacting to noise and misinformation. Boxes are also psychological tools. They provide confidence, clarity, and the ability to wait patiently. The trader knows exactly where entry, stop, and breakout points lie. This framework transforms uncertainty into actionable information, reducing hesitation and emotional interference. When combined with the mastery of fear and greed, boxes become a foundation for systematic scaling and disciplined pyramiding. Seed payoff: boxes explain why waiting, pyramiding, and tape reading align perfectly. Professionals act with purpose and clarity, using structure to guide every decision. Amateurs, lacking this framework, act on hope, impulsivity, or hype, and inevitably pay the price. The next critical layer builds on this foundation: risk scaling and position size. The silent leverage professionals exploit to grow accounts steadily while amateurs overexpose themselves, chasing volatility without discipline. Understanding boxes primes the trader for precise sizing, controlled risk, and systematic scaling. Amateurs overtrade. One stock, one idea, one emotional impulse becomes a cascade of reckless decisions. They chase every green candle, increase size impulsively, and gamble on hope rather than evidence. Darvas approached risk differently. He calculated it meticulously, never risking more than a fraction of his account on any single trade, and adjusted position size based on volatility and probability. Each trade had a defined risk, a clear stop, and an allocation that ensured survival, regardless of outcome. The market could move unpredictably, his account would not. This discipline created the foundation for consistent profits and long-term growth. The professional rule is simple but non-negotiable: always size small. Calculate risk relative to your stop-loss and total capital. Never allow a single trade to threaten survival. Control risk first, profits second. Many traders invert this principle, seeking large returns without first defining exposure. They learn too late that emotional stress compounds losses far faster than market volatility ever could. By sizing small, the professional preserves capital, maintains mental clarity, and creates flexibility to act decisively when high-probability opportunities appear. Maxim: small size, big discipline, long survival. It is concise, actionable, and fundamental. Survival is the prerequisite for profit, and size is the tool that enforces discipline. Consider a scenario: a stock is forming a breakout above a pivotal point, volume confirming the move. The amateur, seeing potential for a large gain, allocates a huge portion of their account, ignoring volatility, stops, and tape. The stock wavers, and losses quickly escalate, triggering emotional decisions. Darvas, in the same setup, sizes modestly, places a stop below the box, and waits for confirmation. If the trade fails, he loses a small fraction of capital. If it succeeds, he can pyramid safely. The difference is not skill alone, it is measured aggression coupled with survival-first discipline. A pattern interrupt here is essential. The market does not owe you anything. No matter how confident, clever, or well-informed you feel, survival comes first. Proof and confirmation precede large exposure. Measured aggression works because it is grounded in evidence, structure, and risk management. Acting impulsively, over-leveraging, or over-trading is a recipe for emotional exhaustion and financial erosion. Professionals internalize this, creating rules that are followed regardless of fear, greed, or excitement. Position size also governs pyramiding. Without careful sizing, adding tranches becomes reckless, exponentially increasing risk. Darvas scaled systematically, ensuring each addition had controlled exposure relative to capital and the initial stop. The amateur, blind to these calculations, risks ruin by compounding uncertainty. Professionals understand that controlled sizing and risk calculation enable patience, waiting, and tape interpretation to function effectively. Every principle reinforces the others, and all require that risk be quantified and preserved. Another dimension, small sizing preserves flexibility. It allows multiple opportunities to be taken simultaneously without overextending. It also reduces psychological pressure, preventing fear and greed from hijacking decisions. A modestly sized position can weather volatility, wait for confirmation, pyramid methodically, and respond to tape evidence without triggering emotional interference. The amateur, overexposed, experiences each swing as catastrophe, never mastering the rules they observe superficially. By mastering position size, you cement the final pillar before integrating all the Darvas principles. Boxes, tape reading, waiting, pyramiding, stop-loss discipline, and emotional control all converge when risk is properly scaled. Professionals move systematically, with measured aggression, capital preservation, and evidence-based action. Amateurs remain reactive, under psychological siege, and over-leveraged. Understanding size, risk, and control transforms trading from impulsive gambling into a repeatable, survivable system. Next, the final chapter ties all loops together: psychology, rules, boxes, tape, patience, into the complete Darvas mindset framework. Here, all principles converge into a single coherent structure, ready for practical application in real-world markets. Now, all rules converge. Professionals cut losses fast, pyramid with proof, wait as a position, read the tape, control fear and greed, respect boxes, and size small. Each element is a pillar, but it is their integration that forms the invisible skeleton of Darvas success. Alone, a stop-loss is merely a safety measure. Pyramiding without confirmation is reckless. Waiting without a framework is hesitation. Together, they form a coherent system where psychology, structure, and disciplined execution align to produce consistent results. The seeds planted throughout this series, patience, pivotal points, tape reading, risk control, emotional mastery, combine into a framework that filters out impulsive traders and elevates those willing to follow disciplined rules. Consider the mindset of a professional. The tape moves, a breakout forms at a pivotal point, and the trader assesses risk, calculates size, and confirms with volume before acting. Losses are cut immediately if the setup fails. Position size is small, ensuring survival and flexibility. Waiting has been employed as an active position, ensuring that impulsivity did not dictate entry. Pyramiding occurs only when the market proves the thesis, and every addition is measured against prior pivotal points. Fear and greed are acknowledged, but never acted upon. Boxes define structure, and stops protect capital. Each principle reinforces the others, creating a feedback loop of disciplined decision-making that amateurs cannot replicate. The actionable takeaways are deceptively simple but powerful. First, cut losses fast. Allowing losses to grow is the primary cause of account depletion and emotional chaos. Second, size small. Risk must always be controlled, not assumed. Third, wait. Treat patience as an active position. The tape will tell you when opportunity aligns with probability. Fourth, Own the process. The market is indifferent to your desires. Profits follow process, not emotion or hope. Professionals understand that each principle compounds. Risk control amplifies pyramiding, waiting strengthens tape reading, and disciplined execution reinforces emotional mastery. Amateurs see rules in isolation. Professionals see them as an integrated system. Here is the payoff for all the nested clues and seed principles introduced earlier. Waiting was emphasized because it allows pyramiding safely. Tape reading was highlighted because it guides entry, exit, and position sizing. Emotional control underpins every decision, ensuring stops are respected and impulsive moves avoided. Boxes provide structure, allowing clarity in volatile conditions. Size management ties all actions together, ensuring that even when trades fail, survival is preserved. When these rules are applied systematically, the trader moves from reactive impulsivity to proactive strategy, leaving the majority of amateurs behind in a cycle of repeated mistakes and regret. The Darvas mindset is not complex, it is disciplined. It demands patience, observation, and respect for risk. It rejects hope-driven trading and embraces evidence, confirmation, and structured action. Following this framework consistently separates the 2% from the 96%. Survival, proof, patience, and structured execution compound over time, creating an edge that cannot be easily replicated without discipline and adherence to process. Finally, a soft bridge to the next lesson. If you have absorbed these rules, the next video on timing and sector rotation will deepen your mastery, showing how to leverage this framework across multiple stocks, sectors, and market conditions. By mastering Darvas' integrated system, you are no longer a participant in the chaos of impulsive trading. You are a professional operating with clarity, structure, and control.